Sure, boy. So I'm gonna start with question one. So in terms of reading the scenario, I'm gonna go like very fast in terms of reading the scenario because I just wanna focus on the questions that you sent. So okay, it says question one, you are a mid-level accountant. Yeah, you're a mid-level accountant at Doughboy Bakeries. Okay, so I'm gonna skip that first part, because they're just explaining. And then the most important thing, okay, and yeah, and then preference shares, they said in 2022, Doughboy has been exploring options to extend their product offering, take their goods beyond the food sector, okay, to raise capital for development of these new products. The company issued preference shares as follows. Okay, so yeah, definitely this thing is a financial liability, right? So they said they issued 100,000, 7% partially redeemable cumulative preference shares were issued for 121 each on 1 January 2023, right? And then they say the preference shares are semi-annually, they are payable semi-annually in arrears on 30 June and 31 December each year. A portion of the preference shares will be redeemable on 31 December 2026 for 9,075,000 in cash, and the balance will be converted into 50,018 rand ordinary shares in Doughboy. So this one, these ones, so this is not necessarily a financial liability. This thing is a compound financial instrument, ne? Because it has a liability portion and an equity portion. One, because a portion of these preference shares can be converted into equity. So it ran a liability portion and equity portion, making it a compound financial instrument. And how do you do compound financial instruments? The first thing you do is you calculate the present value of the preference shares like you would like in a normal liability calculation. One. So you calculate the present value of the preference shares, and then that amount how for total present value, I think you are going to minus that present value from the loan amount, like for the preference shares, like the preference shares amount, and then the balancing figure is the equity. Mari, you'll see in the end. Ha re tlo tswella ka yona. So here they give us the present values here, 8.5 less 7, okay. And then receivable, they say in the beginning of the year, Doughboy sold a shipment of baked goods to Boss Traders, an independent chain of supermarkets that just opened in North Durban Cape. The goods were delivered in good, the yeah, the goods were delivered in good order, and a receivable raised for sale of 2.446, with the understanding that this would be paid by Boss Trade in 60 days' time. At year end, the amount was still outstanding. Upon investigation of this matter, it determined that Boss Traders has in fact foreclosed. After several emails, you received the following response from the administrator at year end. So this one, obviously, the receivables are normal financial assets. And then maybe it's so they're talking about expected credit loss. Because as you can see more, this business Boss Traders is about to be foreclosed, meaning that you might not receive all of the maybe it's 2.446,000 because it's closing down. So you might receive only a portion. So here they're telling us that there's a 20% chance that you'll receive the full amount, 30% chance you'll receive 1.8, and 50% chance you'll receive 1 million, right? So basically on total calculator more, you are just gonna multiply these amounts with the probabilities, right? And then add all of these amounts because they offer probability 100. So when you add all of the probabilities, they will give you what you expect I wanted to receive like at the end. So that amount is what you expect to receive. So when you take this 2,446,000 minus that amount that you expect to receive, then it offer expected credit loss, which is, yeah, the one that you deduct. And how do you deduct it? You say, baby tongue, you debit um loss allowance, right? And then you're gonna credit what do you call this? Um Provision on loss allowance. Yeah. And then yeah, that's basically it for this one. Then this part for the receivable is not really that necessary because here we were dealing maybe ka the receivables. So receivables, they don't necessarily go maybe the present value way. Yeah. Okay. Yeah. Okay. So question no about more. Let me just check what questions you said I should do. Okay. So it's a B. Prepare all journal entries relating to the preference shares issued by Dope Boy for the reporting period ended 31 December 2023. Right. So for the journal entries, Mon, right. Let me just see more again. Barre, prepare all journal entries for the period ended 31 December 2023. So Bamina this year, right? At the end of this year. Okay. So these preference shares were issued at the beginning of the year. Do you see 1 January 2023? So the first thing is you must start with initial recognition. Like an initial recognition, yeah, thing. Like I said, you're gonna firstly baby tang. You have to include the amount that you received right on 1 January 2023. And the amount that you received is 100,000 multiplied by baby tang. This 121, right? That's the amount you receive. So the amount the uncle bank. So it over debit bank with this amount, yeah, 121 multiplied by 100,000. So 121 multiplied by 100,000. Yeah, that gives you, yeah, 12.1 million. Yeah. Auto debit a bank that amount. And then what you're gonna do is you're gonna calculate the present value of the liability portion. I get a compound instrument. Like I said, you must calculate the present value. Then they already gave you the present values. The present values must always be calculated um using the market related rate. So key market related rate 8.5. They calculated it using this one. So you're gonna use this first one. So which means you're gonna credit. So you're gonna debit bank and credit maybe it's a liability with this amount. One, the present value of the liability, which is this amount, right? And then the balancing figure, which is the 12.1 million minus the nine, this amount, yeah, liability. Then that gives us 2.7 million. Yeah, that's the equity. Yeah, that's the equity portion. And then that's initial recognition, yeah, thing, right? And then after you are done with that initial recognition, now we are going to subsequent recognition, which is what we do at the end of the year, right? So at the end of the year, you're gonna firstly calculate interest for the liability. So interest liability to by bitsang that 9326 multiplied by 8 8.5%. So multiplied by 8.5%. That gives you 792,792, right? So that amount take interest ew. So taking as like interest. So it over finance cost you debit, right? And then baby tongue, the liability you're gonna credit, right? And then what you're gonna do is after more you're gonna account for the payment, right? And the payment is that 100,000 times 121, right? Times 7%, right? So times 7%, that gives us 847. So as you can see, what were debit maybe it's an 847 bank, and then you have to credit the what you call this? You have to credit the air interest in, so the amount the interest. But as you can see, the interest amount like is higher. So which means the portion is it's in, you're gonna reduce the maybe it's at the equity with that portion. Yeah. So that's what you do. Those are the general entries that you do. Yeah. So which means air convertibility. Uska calculator anything. That's 50,000 ela 18. For equity, you don't do anything, highly compound instrument. You just calculate the liability portion and then baby tongue. The equity portion is just anything like that remaining. Yeah, go equity portion. So equity portion is just the balancing figure of like calculating the interest, the payment. Yeah. And then if we go to the next question, maybe it says prepare the relevant journal for the expected credit loss relating to the receivable at 1 December 2023 in the accounting records of Doughboy. So how are prepare SKH, I guess so. Scalable the expected credit loss. Like I said, general intra thing is simple. It's just loss allowance. Then you debit loss allowance, which is a PNL, and then you credit provision for loss allowance, which goes to SFP, right? And it's like the amount, the expected credit loss. So now in this case, the first thing you're gonna do is you're gonna calculate what you expect to receive. So that's not the expected credit loss, that's what you expect to receive, right? And what you expect to receive is basically there's 20% multiplied by that, 30% multiplied by that, 50% multiplied by that, one. And then the results of it really, so by multiplying this with that, you're just gonna add them up together, and then that's like the weighted average probability. That's what you expect to receive. Then you're gonna take this amount which they owe you, again, minus what you expect to receive, and then that is the expected credit loss. Then not a loss allowance, you debit, and then provision for loss allowance you credit. Then that's basically it. Yeah, that's basically it. And then yeah, that's question one, right? So I'm not gonna go really like deep mo teng kare nka se ke kgone go fa like deep mo tsone dilo tse vandag. So I'm just gonna give you like the technique for tsone. Let's just see question two. Barring. Okay, so let me just see question two. It's overtlying. Okay, so A, B, C. Okay. So gonna start with A. So it says prepare the pro forma journal entries required to account for the intragroup sale of inventory from jacket check to great coat when preparing the consolidated financial statements of Great Coats Group for the reporting period ended 30 June 2023. Right, yeah, okay. So, bare intra-group transaction, yeah, inventory. Let's just check more. Okay. Okay, yeah, this is it. So it says since acquisition date, Great Coats has been selling inventory to Jacket Check. Great Coats sells inventory to Jacket Check at a markup of 33.3% on cost. During the year ended 30 June 2023, inventory sales from Great Coats to Jacket Shed amounted to that. Of the inventory bought by Jacket Check from Coats, 56,000 was still on hand. Yeah, okay. So this is basically what they want in terms of the intragroup transaction. I get. So pro forma journal entry, e re tlo etsa right ke inventory. So you have to pay attention. Yeah. So there's two steps. I get it here, it's inventory to inventory. So there's two steps for inventory to inventory. The first step is you have to eliminate the sale, right? So how do you eliminate the sale? You are going to say, maybe it's you debit revenue, and then you credit cost of sales with the amount of the sale, right? So during the year and the 30 June 2023, inventory sales from Great Coast to Jacket Check amounted to 305,000. So this is the amount of taking young. So to debit a revenue with 305,000 and then credit cost of sales with 305,000. And then the second part, number two, is you're gonna eliminate the unrealized profit. Okay, so you're gonna eliminate the unrealized profit, right? And how do you eliminate the unrealized profit? By using this journal entry. You're going to debit cost of sales and you're gonna credit inventory, right? With the profit, right? The profit on the sale, right? So how do you calculate the profit on the sale? Or those are the 305, right? Yeah, multiplied by 33,33 divided by 100 and yeah, this one. So this thing we enter right value, right? And then that's what you put as the amount, right? Mare auto debit cost of sales and then credit inventory, right? And then no. And take for unrealized profit, you're not gonna use the 305, ne? You don't use the 305. So the 305 you use for the sale. But for maybe some for the unrealized profit, you're going to use this 56,000. So you're gonna use the closing stock, ne? So what's on hand? So you're gonna use that 56,000. Yeah. You're not berekisa mo. Then that's the amount of lekinyang when you say debit cost of sales and credit inventory. Yeah. And then you also have to the other journal entry that you do have to do is you have to realize profit last year. I get it. So do you see here the last year there was closing stock, meaning that um baby tongue, you have to take out the unrealized profit more, right, for last year. Scalable because group journal entries are scratched, so you have to take out the unrealized profit lame of like for last year or we realize that this year. So when you take out the unrealized profit, right, it will be a baby tongue. Basically, or close to the same thing. Cost of sales you debit, inventory you credit, right? Mare kare kya last year, that cost of sales is gonna be retained earnings. So it's gonna be retained earnings you debit, and then inventory you credit, and then you're gonna see the 68,000 multiplied ka fraction E. I want. Then which means you took out the unrealized profit yeah last year on this amount. And then what you're gonna do is you're gonna now realize this profit this year. I want. So how do you realize this profit? By just doing the opposite journal entry. So you're gonna debit inventory and credit cost of sales with the profit amount. So with the 68,000 multiplied by this fraction and then of it. Okay, so just to recap, man. So the first thing is you have to eliminate the sales that this year, right? By debiting revenue and crediting cost of sales. So with this amount, with the full sales amount, yeah, this year. That's the first step. Second step is to eliminate the unrealized profit from this year's sales. That one. So we are gonna eliminate the unrealized profit from this year's sales. So from the closing stock, right? So we are gonna take this 56,000, re-multiply this fraction in, and then we say cost of sales we debit, inventory we credit. Then that's how we eliminate the, what do you call this? The unrealized profit, yeah, this year. And then we are gonna go to last year, right? So last year we will see, oh, last year we had closing stock of 68,000, meaning we have to take out the unrealized profit from last year, right? So we're gonna take the 68,000 multiplied with the tax fraction, and then we have to say debit cost of sales and credit inventory, right? To take out the unrealized profit. However, because last year, the cost of sales will be retained earnings. So it will be debit retained earnings, credit inventory. And then for this unrealized profit that we took out last year, we have to realize this year. So we're gonna take the 68,000 multiplied by the fraction, and then maybe it's cost of sales with I mean inventory with debit, and then cost of sales with credit to realize the unrealized profit. Yeah, that's basically it for that one. And then but calculate the profit on sale on the dry cleaning machine that will be recognized in the consolidated financial statements of Great Coats for the year ended 30 June 2023. So profit on sale on the dry cleaning machine. Okay, here's the dry cleaning machine. So it says, um, okay, at the date of acquisition, all jacket shirts, assets, and liabilities were fairly valued with the section of the following assets. So jacket checks, dry cleaning machine, which codes considered to be undervalued by that amount, right? Which had a remaining useful life of 4 years and nil resolve value on 1 July 2020, right? So this 1 July 2020 acquisition date, right? So let's just see more question what line. It says calculate the profit on sale. Okay, okay, this machine was disposed of on 31 December 2022, and Jacket Checker organized a profit on disposal of 135,000 on the date. Yeah. Okay. So um okay, so Babatla profit on sale that will be recognized on the group records. So basically Babatla group profit on sale. So what the group made in terms of like the profit, right? So let's just see Mobaring, right? They say on 1 July 2020, right? Let's just see more. Where is that thing? Did they give us the cost for the, let me just check if they gave us the cost. Yeah, this dry cleaning machine. Okay, it doesn't look like they gave us the cost for the dry cleaning machine. I get when it cost that thing. Yeah, I don't think, yeah, 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 okay, yeah. So, okay, they said that it was undervalued by 120, right? And then the machine was disposed of on 31 December, and Jacket Shed recognized a profit on disposal of that amount, right, on the date. So you do realize, obviously, the profit on disposal that the subsidiary recognizes will not be the correct one, I get it, because that asset was not fairly valued on date of acquisition, right? So which means from the date of acquisition, that asset, according to the group, is only valued at an amount that is lower than what it's supposed to be, right? So, baby Zhang, we are going to have to account for that 120L, right? And then on the profit on disposal, right? So let's just see how we get profit on disposal. Profit on disposal basically it's basically your consideration, I get, that they paid minus the accumulated depreciation, right? And ntho e re covering ke gore, as you can see, the accumulated depreciation here, like that the subsidiary will have, will not be the same as the accumulated depreciation according to what the group says it should be. One, yeah. So, the carrying amount, that thing like will not necessarily be exactly the same as what the group says it should be. One. So basically here, what I'm saying is that Sonzo calculate the extra accumulated depreciation that you had from acquisition date until the end of the year, Wabon, using this 4 years in. So you're gonna take this 120 divided by 4 years, and then weigh it for the number of years from 1 July 2020 until the end of maybe it's 31 December 2022. And then that will give you the accumulated depreciation extra, right? And then that accumulated depreciation extra, you're gonna minus it from this profit, and then that will give you the group profit. So the group profit will be lower than the profit their subsidiary, because subsidiary does not have that extra accumulated depreciation it should have. Yeah. And then see, it says calculate the investment in associate balance that will be recognized in the consolidated financial statements of Great Coats Group. Okay. So they want the investment in associate, right? So, okay. So the question is a investment in associate balance, right? That will be in the consolidated financial statements, right? So for this one, Clover Vela formula is simple. So for this one, you're gonna start firstly by saying consideration. So whatever you paid for the consideration, right? And then number two, whatever you paid for that consideration, you're gonna add gain. If you have a gain on bargain purchase, you're gonna add that gain on bargain purchase. But if it's goodwill, you don't have to add goodwill to the consideration. So step one, the consideration that you paid for the associate, plus gain on back end purchase. If it's goodwill, you don't do anything. You don't add or subtract whatsoever. So which means when you are doing this investment in associate, you must always do it mo le side-eng o etsa gape le analysis of equity. That's essential to know gore whether you have goodwill or gain on bargain purchase, right? So, like I said, I'm not gonna go like deep into this question. Ke tlo bolela fela approach that you have to take for these questions. So, this is the consideration that they paid, right? So, ke yona amount o tlo e kenyang pele, and then obviously you're gonna use this thing, this ordinary share capital retained earnings to lay this consideration to see whether you have goodwill or gain on bargain purchase, right? But I think here most probably you have um I'm not sure, but it might be goodwill, I'm not sure. But I'll check if it's gain on bargain purchase, then you have to add that gain on bargain purchase to this 105. It's part of the investment in associate, right? And then how feta, but all of the assets in Shuin were fairly valued with the exception of Shuin's building, Ankara buildings here, which were correctly classified as property, plant, and um, equipment, right? Yeah. So, let this thing, like, or one of this thing, they were not fairly valued, right? These buildings, right? They were not fairly valued. So, loan, that fair value adjustment, you have to include it, go, um, analysis of equity. So that equity at acquisition, this is equity at acquisition. You have to include it in that analysis of equity, but you don't do anything like to the investment in associate, even no journal entries are one. You just included core analysis of equity to see whether or not you have goodwill or gain on bargain purchase. So that thing I mean elimination lay equity acquisition, like it doesn't change when you're doing it on the analysis of equity. It only changes how later the what do you call this, the general entries, and also when you're calculating the investment in associate, because we only consider the consideration like in on buy and purchase at acquisition. Then as a since acquisition, we consider now the same things we consider for like groups. I get but the building had a cost of 800,000 and accumulated depreciation of that, right? On 1 July 2021, right? So we acquired it. So acquisition date ke 2022. So next year, the remaining useful life of the building was estimated at 8 years and nil residual value. These estimates have remained unchanged, and grade codes considered the fair value of the building to be that amount on 1 July 2021. I think the date mo ba di yeah, yeah, ha ba spinisa di-date sentle mo wa bona, because this date and this date has to be the same date. So I'll assume nje ke 2021 ne le acquired it ka 2021. Yeah. So this one, that's why like I like using the analysis for maybe for associates, because for the analysis will remain exactly the same as you do with groups. Mare, even the general entries will remain the same. So hangata akere with groups, these buildings, they are not, as you can see, at acquisition date, right? The carrying amount of the buildings, right? The carrying amount of the buildings and the fair value of the buildings is not the same, right? Meaning that, as you can see, I think like when the carrying amount is about 240, yeah, and fair value get 320. So according to the group, this thing has to be 320, mare it's 240, right? Meaning that the subsidiary will continue, I mean, the associate will continue to record depreciation at a what? At a, what do you call this? At a much, so it'll continue recording depreciation at a lower rate than what the group expects, right? So you have to fix this discrepancy, right? And then when you fix this difference, right, because ke yone equity acquisition, then normally you do depreciation like ya gore like with a way depreciation throughout the year. So the only difference with this one is just that um you are going to what do you call this? E ka se ke affect it won't affect like accumulated depreciation, late depreciation. So what I mean is that the first thing that you should do is baby tsang kore fela mo a ke wa bona like le mo ha ba re fa le profit at all or like yeah, because normally you have to attribute the profit, right? So attribute the profit by using the channel entry by saying investment in associate you debit and then you credit share of profit in associate. One. That's what was supposed to happen. One. So for this one in a depreciation, you are just gonna say depreciation. I mean not depreciation because you cannot use depreciation. So instead of depreciation, you're gonna use share of profit in associate. You debit with the amount of depreciation multiplied by 30%. And then by Bizang, you're gonna credit, you're supposed to credit accumulated depreciation. But because there's no accumulated depreciation, you're gonna credit Bizang investment in associate, right? With the depreciation amount multiplied by 30%. Yeah. And then don't forget happily deferred tax like throughout the other groups. Or there's deferred tax in every pro forma journal entry, you have to do deferred tax modeling. Yeah. And then yeah, that's basically it for this one. Yeah, number two. And then let's just see the third one. Okay, it says provide pro forma journal, pro forma consolidation journal entry that should be processed by own Harvey Housing for the reporting period ended 30 June 2022 to correctly account for the housing in its consolidated annual statements. Right. So okay, Guillermo. Okay, so own acquired controlling interest in the ordinary shares of Mudamulo for 208,970 on 1 July 2019 when the equity consisted of the following. Okay. Okay, Bare own advanced the long-term loan of that in favor of the sub on that, right? The loan is interest free. Okay. Let me just check what mm, yeah, this is the only information, Gav. So I guess the performance marginal entries are maybe it's mostly at acquisition. Yeah. So to look at the other acquisition general entries. So as you can see, they didn't say anything about the assets and liabilities. So we'll assume that all the assets and liabilities were fairly accounted for. So there's no equity acquisition. So we'll go step two immediately, which is the what do you call this? The main elimination journal entry. So we're gonna start by saying firstly we debit the share capital with 80,000 and then we are gonna credit the retained earnings because they have accumulated losses. But normally we debit the retained earnings because retained earnings get credit balance. So but because now they have losses, these retained earnings are a debit balance. So that's why we credit them. Yeah. And then by Wisang, we are going to, what do you call this? We are going to credit also the investment, right? This amount, which is this um 2897 in, right? And then um okay, yeah, we are supposed to also, what do you call this, credit the NCI. Mare ke mo ha ba bue gore le how much stake acquired the controlling interest of the, yeah, but they don't, yeah, they're not telling us the percentage. Let me just see. Okay, okay, ke ye mo. Okay, so they said we bought 48,000 shares from N2. So let's just check how many percent. I think it's about, yeah, 60%. So it's 60%. So non-controlling interest is 40%. Yeah. Mm. So yeah, you are gonna take this 80,000 minus this amount in, or multiply ka, what do you call this, 40%, and then you're gonna debit it as NCI. Yeah. Normally my NCI you credit, but because um the equity has now a credit balance that we're taking out, the NCI will be debited. Mara normally we credit the NCI. Yeah. And then the balancing figure here, it's either will be goodwill or gain on bargain purchase. One. And then that's the first part the way it's like, and then in let's just see more about it. Okay. So they obtain a loan, one, yabokan, interest free. So what you just have to do is cancel this loan, agar, by debiting the loan, right? Debiting the loan and then crediting the the loan as the financial asset. So you're gonna debit the loan as the financial liability. So by canceling it out in the books of the subsidiary, and then you're gonna credit it as a financial asset in the books of the asset, thereby eliminating it in the books of the um what do you call this, the parent. Yeah. And then just check more. Okay. So B, it says provide the main elimination channel entries that should be processed by own housing for the reporting period ended 30 June 2022 to account for. Okay, so they said the main elimination for this one, right? So okay, so you acquired 100% interest. Cost of the investment was that. Okay, okay, okay. So, but we acquired it on 1 October 2021, right? So we acquired it during the year. One. We acquired this thing during the year. Let me just go to it. Yeah, we acquired this ish. Yeah, we acquired this thing during the year. 1 October 2021 is during the year because year end is 30 June 2022. Yeah, so we acquired it during this year. right? And then baby I assume, yeah, all the assets and liabilities were fairly valued because they didn't say anything about them not being fairly valued. So which means there is no equity acquisition. So the first step is we are going to debit the share capital, and then we are gonna credit the retained earnings. Like I said, normally we what do you call this? We debit the retained earnings because the credit balance, but because the loss, we are going to credit them in this instance. And then um, we are going to credit also the investment, right? Investment in sub, which is this amount, right? And then we are also going to take this profit for the year, right? You see. Okay, so they say this is the profit for the year. They say this is the average turnover per month, right? And the cost of sales is calculated as a percentage of turnover and is consistent throughout the year. Okay, so yeah, so for this one, what you have to do is also calculate the profit portion, right, from the beginning of the year until um the date of acquisition. Yeah. So until beginning of the year until date of acquisition. Yeah. So they told us more gore average turnover ke bokae, right? So average turnover is that amount per month, right? So if average turnover is that amount per month, right? So that means that barely this figure increased by 20% per month from the date own acquired the interest in yeah the sub, right? So own acquired interest in the sub ka 1 October. So which means from July, so July, August, September. What do you call this? Yeah, July, August, September. Those 3 months, the turnover, meaning the sales, will still be Correro was 148,000, right? And then from there on, the sales from there on, it didn't increase like 20%. I want it didn't increase like 20%. So meaning for the first month, this will be the amount, yeah, um, of the sales. So it seems like they try to make it like complicated because I don't think for your level it should be that complicated. So if Nikelo and I just take this amount, their profit in, and then like I said, get 3 months from beginning of the year until acquisition date, then you're just gonna take this amount and say 3 divided by 12, and then that gives you the profit attributable to those 3 months because we regulate during the year. Then what you're gonna do is you are gonna debit that profit deal. So you're gonna debit that portion area 3 months you debit that portion. Yeah. And then that portion ill that you debited plus the share capital, right? Minus the retained earnings. That gives you the fair value of the equity, right? And then you're gonna multiply that amount with the percentage, yeah, non-controlling interest because barely it's measured at the net proportionate share. You're gonna multiply it by percentage and non-controlling interest. In this case, uh, oh yeah, there is no non-controlling interest because they said you bought 100%. So which means you won't need to credit or debit non-controlling interest. So after you get value this what do you call this profit amount, the only thing that will be left here is balancing figure, which is goodwill or gain on bargain purchase. Yeah. I hope, yeah, that was helpful. Sure.